Cafeteria plans, also known as flexible benefits plans, offer employees a menu of benefit options from which they can choose according to their individual needs. Some benefits are provided as core options that all employees receive, such as basic health insurance or life insurance. Beyond the core benefits, employees can choose additional options that best suit their personal circumstances. For example, they might opt for extra coverage or choose a childcare subsidy over additional health insurance. Employees are often given a set amount of benefit credits or a budget that they can allocate towards the benefits they choose. This allows them to tailor their benefit package to their specific needs and preferences. Many cafeteria plans include benefits that can be offered on a pre-tax basis, such as flexible spending accounts, FSAs, for healthcare or dependent care expenses, which can provide tax savings for employees. In this video, we'll learn more about the taxation of cafeteria plan benefits. A cafeteria plan is a separate written plan maintained by an employer for employees that must meet the specific requirements and regulations of Section 125 of the Internal Revenue Code. It provides participants an opportunity to receive certain benefits on a pre-tax basis. The employee can select from 2 or more offerings and tailor to their specific needs. So let's first talk about medical benefits. There are several classes of medical benefits that qualify as Section 125 cafeteria plans. The most common of the cafeteria plans involves medical insurance for employees. Premium-only plans, or POPs, is a cafeteria plan type that allows employees to deduct premiums for the benefit on a pre-tax basis, which reduces both the employees' and the employer's FICA tax and may include medical, dental, vision, and other plans. Flexible spending arrangements, or FSAs, is another type of cafeteria plan benefit that assists in the payment of medical expenses, childcare expenses, and prescription costs, and transportation. IRS Publication 502 provides more examples. Employee contributions are limited to $3,050 in 2023 and $3,200 in 2024. Contributions above these amounts are treated as taxable income. Typically, FSAs have a use it or lose it provision, meaning you must use the funds that were set aside as part of your payroll deduction by end of year. The IRS permits up to $500 rollover annually per employee at the employer's discretion. That limit is $610 for 2023 and $640 for 2024. So how does the FSA work? Before the year begins or when you start a new job, HR will ask you if you want to contribute to an FSA, and if so, how much. You decide on the amount, but it can't be more than the annual limit. Then, as part of each paycheck, you have a proportionate amount withheld. And when you pay for expenses that are reimbursable under the FSA, you submit a receipt to the FSA and get the money back. Many FSAs have a mobile phone app to make it convenient. And because the dollars were deducted pre-tax from your paycheck, you saved money. However, you have to consider, are the tax savings worth the effort of having to monitor your spending and submit expense receipts to the FSA? Will you potentially forfeit some of the money that was withheld from your paycheck because your circumstances changed? Also, you may lose the FSA money unexpectedly. For instance, some FSAs have provisions that when your job has layoffs, you can only submit qualifying expenses up to the date of your layoff. An FSA is a good fringe benefit. Please read the fine print. We've been talking a lot about pre-tax deductions. Let's take a closer look at what that exactly means. Here we have one calculation where the deduction is post-tax without a cafeteria plan, and the second calculation is where the deduction is withheld pre-tax with a cafeteria plan. The gross wages are the same, but the net pay is different. Both calculations begin with the gross wages of $2,500. Deductions that are allowed to be pre-tax deducted reduce both income taxes and FICA. In this case, the cafeteria plan and the pre-tax deduction resulted in tax savings of $86 per paycheck and annual savings, assuming a biweekly payroll, of $2,236. As with all things taxes, there are some exceptions. Some pre-tax deductions, such as employees' portion of health insurance, is a pre-tax deduction for federal, state, and FICA taxes. Other pre-tax deductions, such as the 401k deduction, is only a pre-tax deduction for federal and state taxes, but not for FICA taxes. Health savings accounts are another type of offering in cafeteria plans. HSAs may only be offered by an employer if the health plan they offer their employees has a high deductible as defined by the IRS. The minimum health plan deductibles in 2023 are $1,500 for employee only and $3,000 for the family. And in 2024, $1,600 for employee only and $3,200 for the family to qualify for the HSA. The health savings account functions like a bank account in that the employee owns the funds contributed, although employers may also contribute funds. Unused funds roll over each year and continue to grow with the account. Unused funds do not affect the yearly contribution limits. So let's look at the contribution limits. For 2023, there are $3,850 for a single individual and $7,750 for a married couple. And in addition, employees age 55 and older may contribute an additional $1,000 per year as a catch-up contribution. Employer contributions to HSAs are tax exempt as far as federal income tax, FICA, and FUTA, because sums contributed are not considered employee wages. The contribution limits have increased in 2024 by $300 for single individuals and $550 for married taxpayers. The catch-up contributions for taxpayers age 55 and older remains unchanged. HSAs differ from FSAs because the funds may be set aside for use later in life. Employees who are not offered an HSA by their employer may set one up with a trustee. HSAs are considered to have a triple tax benefit. Contributions up to the limit are tax deductible, any investment income is tax-free, and withdrawals are tax-free if they're for qualified medical expenses.